Good afternoon and welcome to this webinar. And today we have with us Andrew Bird, who's the chairman of Sharesight, and he's going to give his personal perspective on how he manages his SMSF using Sharesight. A quick intro about Andrew. Obviously, like I mentioned, he's the chairman of Sharesight. He also co-founded Huntley's Aspect way back in the 2000s. And he was also the CEO of Morningstar Australia for a period of 5 years in that time. Besides Sharesight, he has a bunch of other startup investments as well as on the board of some other companies. So welcome, Andrew, and thank you for giving us your time to give your perspective on Sharesight. Now, before we hand over to Andrew, we just have some quick slides and housekeeping to go through. So in terms of the agenda for today, we have an introduction, the webinar content, which is primarily Andrew going through a bunch of features and how he actually implements a lot of use cases within Sharesight. We'll give ourselves some time for the Q&A right at the end. An important disclaimer. Now, Andrew will show you some of his investments and may talk about some investments, but none of it is any kind of advice. It is purely for educational and information purposes only. So I won't go through that entire disclaimer, but I hope that's fairly clear that it's purely for educational purposes.
Thanks, Prashant. Welcome, everyone. Great to have you join in this webinar, and I look forward to running through how I use Sharesight to run my SMSF. I guess just to start off and give you a little bit of background, and actually seeing that picture of me in that first slide, it makes me realize that I've aged quite a bit since that picture was taken. It's probably 10 years old, and I didn't have a lot of gray hair then. I certainly do now. So anyway, I guess that's what SMSFs are all about, right? It's about saving and preparing for retirement. And I'm certainly a lot closer to that than I was 10 years ago. And in fact, it's there've been a few changes with my SMSF. So just to give you some context, I mean, I've had it probably for 20 years at this point, and it's been, I've used it obviously for super contributions from work. I've made quite a lot of after-tax contributions as well. The balance, my wife and I, we're over that 3 million mark. So thinking hard about some of the new rules and what that means for us. But probably most importantly, my wife retired from her job in banking a few years ago and has actually started a pension in her side of the super fund last year. And I've turned 60 earlier this year, so I'm actually looking to start a pension in on my side of the SMSF. In terms of work, I sort of have a bit of a portfolio career, I guess, at the moment. So I earn some director's fees, but we also draw down a certain amount from our investments in order to provide spending for our living costs. So it's sort of a blend of income and investments or work income and investments to fund us. And I suspect that's where many of you are as well, whether you've already started a pension or not. But that's ultimately what superannuation and SMSFs are all about. That's actually led to a few changes in how I think about the portfolio in recent times. So why don't we get straight into it? All right, great. So now, am I meant to be, is that the first question, Prashant?
That's right. Yeah, just a quick quick show of poll while you were setting up.
Yeah, okay.
Yeah.
I'll just move it out of the way. But throughout this, you'll get, Prashant's organized a few kind of quick poll questions just to take everyone's temperature on some of these issues regarding SMSFs. But anyway, let me get into this. So This is a demo portfolio, as you can see, but so it's not exactly my SMSF, but all the investments that you see here are investments that I do actually own, and the proportions are not exactly correct, but look, they're kind of reasonably close and gives you an idea of how I do things. So let's talk first of all about custom groups, because that's really the heart of how I look at my portfolio. Custom groups I'm not going to, they're in this account settings if you haven't used them before, but I'd certainly encourage you to play with them. I guess just as another just sort of piece of housekeeping, I'm going to assume that you have a portfolio up in Sharesight and that you have some familiarity with some of the features. So I'm not going to explain them in a huge amount of detail, but kind of just really more talk about how I do things. So hopefully I'm not going to be skipping too far ahead, but obviously we have a lot of help on some of these features if you're not familiar with them. The other thing we're going to talk a little bit about tax and compliance towards the end of this, but the focus really of what I'm going to talk about is how I use the portfolio to run for me, it's a portfolio management tool. It's something I use throughout the year to help me understand what's going on in my portfolio, assess it, make changes. Yes, it does help with compliance at the end of the year, but for me, that's not the be all and end all of the SMSF. If anything, I try and minimize how much time that takes. And importantly, my accountant, who I work with quite closely, uses Class to do the year-end accounting, the sort of financial statements and the actual tax return. So Sharesight plays quite well with Class and feeds a lot of data in there. But in my case, I don't actually use Sharesight to sort of produce some of those reports for tax. Now I do have other investment entities. I've got an investment company. I've got a family trust, and in those cases, I use a combination of Sharesight and Xero to do the full accounting for those particular entities. But because the SMSF compliance is a bit more complicated, there's an audit involved and various other things. My accountant and I have decided that it makes the most sense to use, or for her in my particular case, to her to use Class as well, which is a great sort of productivity tool for her in particular. So okay, so the first thing I want to talk about is just these custom groups. As I said, I look, and for me, this is essentially how I organize my portfolio in terms of asset allocation. And it's sort of a bit of a twist on a traditional asset allocation, I guess. So my groups, and I'll go into a couple examples, are active stocks. So these are stocks that I invest in directly. They're individual shares, typically, that I will invest in without regard to any kind of weighting or what market. So in the active stocks bucket, I've got Australian stocks, I've got US stocks, I've got a UK stock. Really, it's just things that I think are a good idea and that I'm interested in investing in. But I do try and keep an eye on how much I've got weighted into those active stocks, because obviously they are almost by definition a higher risk category than a collective fund. And we can talk a bit more about that. Okay, here's another question, which I think you'll have on your screen. Second category is international passive. Next two categories, and international active. So I've got a pretty big weighting to international, as I'll show you in a little bit. It's, it represents something like 40% of the portfolio, probably. And that's partly, I suppose, due to my accent. I am Australian, but I grew up in the US. My wife's American. So we have assets over there within the SMSF. So it's partly, I guess, there's a bit of country bias, but also just because in my mind, I've always felt that the Australian market is a bit limited in terms of the the industries and sort of company types that you can invest in. And clearly with tech, the US has a much broader range of options there, and that's one that we certainly used. Then I do have private assets as well. So I'll just, the next category is Aussie passive. So this is my exposure. Really, my exposure to the Aussie market is mostly through a passive ETF. I do have some individual Australian stocks in the active stocks category. IGL is a company I'm actually on the board of. It's a small cap listed marketing services and printing company. There's others like, what's another one? Platinum Asset Management. I no longer own that, but I did. SiteMinder, Woodside, etc. So that's the Aussie exposure. Venture equity, here's a company called Critical Arc, which is a sort of a startup. Well, it's several years old now, but a Aussie SaaS business, which I invested in some years ago through my SMSF. Private equity, I have some investments in direct, more mature companies. PMG, Polaris Marine Group, is a marine services and construction business. Most of those companies, most of those private assets, I will say I own outside superannuation. And, maybe if we have time, we can talk a bit about some of the looming changes with 296, which have definitely kind of colored my thinking about where different investments might go in the overall sort of investment portfolio. Then I've got some bonds. In this case, I've got two bond funds, a US bond fund, an ETF, and an Australian one. Now, this is another one where age just sort of has an impact. Up until a few years ago, I didn't own any bonds at all. I've sort of traditionally been quite a growth-oriented investor. And I will say that I'm now starting to add bonds to the portfolio, partly because I'm looking to reduce volatility and sort of de-risk things a little bit as I sort of transition a bit more into sort of the drawdown phase of the portfolio. But also, I think just even more opportunistically, I think bonds haven't been a particularly attractive place to be with super low interest rates. I do think now that they are starting to get a little more interesting. So, really, these purchases, which are still quite small in the relative scheme of things, have come since interest rates have started to come up. And I think I will probably build on that over time. Lastly here, I've got cash as an asset. This is actually a cash ETF, which I own, BILL, which I quite like, run by iShares. It actually pays a similar interest rate to a term deposit, but you can buy and sell it like a stock whenever you like. There's obviously some brokerage fees, but with an online broker, they're not particularly high. So I find that a good way to park cash and still earn a reasonable rate of interest. I also have bank accounts as well, which are not shown here. Those that actually do feed through into my real portfolio through Xero, which I have linked in. Okay, here we go. Another quiz. I'm just going to move that to the side. Now, okay, so that's the portfolio. As you can see, you might say that this portfolio is a little bit of a core and satellite portfolio in terms of, I see the core being ETFs and managed assets. I think passive ETFs have a great role to play in almost any portfolio, even if you're a fairly hands-on active investor as I am. I don't necessarily want to, own stocks around the world to create diversification. I don't want to pick every category, et cetera. I don't have the time nor the inclination to do that. So I really do like having ETFs as a core there. But, just looking at the international active category, I also have things like Berkshire Hathaway, which obviously is a US stock. I don't actually put it, though, in my active stock category because it's so diversified. It has such a big range of holdings, both listed and unlisted holdings. To me, I treat it as an active ETF. So it's a stock you can buy, but it's an underlying, very diversified set of assets beneath that. And so I'm very happy to hold that in my active category. Other things, just to very quickly go through what I've got. Moat, which is a Morningstar ETF, which is sort of it's an active ETF of Morningstar's best ideas, best research ideas. This I have, in this case, the US listed one, but it's also listed in Australia as well, and you can buy it directly on the ASX. Another one I have here, which is a Japanese passive ETF, but I actually put it in my active category because some of these other ETFs, which, like, for example, VEU, that's a Vanguard All World ETF, everything outside the US, does have Japanese stocks in it, but I've sort of wanted to make a oversized bet on Japan. So I've bought an ETF, a Japanese ETF directly. And, to me, that's active because I'm making an active bet to overweight Japanese stocks. So that's kind of how I see it. Quick word about benchmarks. So the benchmark that I use is VDHG, which is a Vanguard Australian listed blended ETF. So what it is basically a collection of several other ETFs in a kind of a fairly traditional growth-oriented asset allocation. So it's got a high allocation to international equities, Australian equities. It has bonds, some property, but relatively low allocation to that. And to me, that's kind of a good benchmark and asset allocation sort of target that to me represents a good benchmark to measure myself against. There's no point in having, for example, you can have STW, which is the ASX 200. So, I mean, that's a perfectly fine benchmark. But in the case of my portfolio, which is quite diversified geographically, it doesn't really make sense to just benchmark against that. Equally, I could choose a Vanguard balanced portfolio or balanced ETF, which has a much higher allocation to defensive assets. That doesn't really reflect how I'm managing the portfolio. So, for now, that works. I think that works really well. Maybe over time, if I start to de-risk a bit more, I might reconsider. But for the moment, that works well. Now, just a quick note on return. So you can see, so here I'm looking at the last 2 years. I'm looking at the VDHG has actually outperformed my portfolio, which on the face of it is not necessarily a great thing. But it's interesting to look at why, why has that happened? Well, you can see I've got my individual stocks which have underperformed. Now I'll go into different time frames for a second. And, at one level, that's not that surprising because by definition, the individual stocks are going to be a lot more volatile. What I look to see is that over a longer period, let's say 5 years plus, that I can outperform some of these more passive benchmarks or passive ETFs. Because if I can't, ultimately, like, what's the point? Why am I spending time picking these stocks, trying to make decisions if I can't get a better return? And as we'll see when we talk about the drawdown report, I'm taking on more risk. So there's got to be a reason. So, okay, short term, not necessarily a great report card there, but I'll show you the longer term in a minute. You can see here, international, both active and passive have done great. U.S. market in particular has been, remarkably strong. You can see here, VV, which is the S&P 500, essentially 26%. And then I've got the Aussie market 11%. Not bad, but it certainly hasn't kept pace with the U.S. in the last couple of years. Again, some of the private stuff, some very good, some, again, volatile over short periods. So not something you can take too much away from. Bonds, predictably less volatile, but lower return. But let's have a quick look at a longer time frame. So this is 5 years. And here you can see, I actually am ahead of VDHG, which is good. It's here you can see the active stocks have actually done pretty well over that period, which is so I don't think I'm completely wasting my time, which is good. Uh, the international has still been great. Interestingly, active has outperformed passive slightly in this case. The Aussie has been, about whatever, just under 9%. Not terrible, but not shooting the lights out. Some of these, PMG actually I bought fairly recently, so there's not a lot of history there. Critical Arc doing pretty well. Bonds, etc. So look, I guess the main takeaway I'd say here on returns is make sure that you're regularly looking up and down the time horizon. So, ultimately, the long term, if you're investing for retirement, investing over the long term, it's the long-term returns that matter. Don't get too hung up on the short term. But, look, I'll be honest, I particularly with all the volatility and things that are going on, I do spend quite a lot of time. I'll look at the last 2 weeks sometimes, not because I'm trying to determine how, whether that means my portfolio is good or bad, but I'm interested in saying, okay, since the US elections, how has my portfolio reacted to a particular event? And as many of you know, the S&P's been on fire, up 6% in 2 weeks. It's kind of incredible. But like some of my individual positions have done very well as well. Schwab, U.S. Financial, some of the financials have done very well in the U.S. So it's interesting to look at the short term just to see. It's really about understanding how your positions are affected by news, not necessarily to make decisions based on that, but it just helps you understand how things react. And that is ultimately, I think, very valuable. Okay, so let's move on. Let's talk about diversity, because the diversity report, if I go into reports, is, going back to the custom groups and sort of the asset allocation question is really a key one to look at. So here I'm going to run this report using my basic asset allocation, which is the one that you saw in the overview. And here you can see this is my current asset allocation. So about 30% in active stocks. If you take the two international positions together, it's just, about 40%, 43, I guess. Australian equities, 10, Australian passive, under 10, bonds, 6, and then the private equity there. So you can see it's probably not your classic asset allocation that your friendly financial advisor might recommend, particularly for someone heading into to more pension mode. But it reflects the fact that I've been, quite growth oriented and prepared to take on some risk. Overall, the returns, I've been pretty happy with them. So to me, it's been worth it. But this is something I do keep an eye on. So, active stocks at 30%, to me, I'm a bit overweight there. I really would like it to be closer to 25%. And why is it 30%? Well, partly it's because some of the stocks have done quite well. So naturally, that's grown that pie. I've also invested in some other stocks recently, like one of them is Wise, which is a company that does foreign exchange transaction, UK listed sort of a fintech, which I think is just a terrific business. It's a business I actually use a lot. I don't know, we might talk about tech stacks and what other products we use to manage our portfolio. I use Wise like maybe some of you do, if I'm traveling overseas as a way to fund, expenditure overseas, but I use it to actually move money between my US portfolio, which is held by Schwab in a US stockbroker, and in my Australian. So we tend to spend money in Australia. If I sell something in the US, I want to move back to Australia so we can spend it. I'll use Wise often to do that because their exchange offerings, exchange rates are way more competitive than my bank, and even other specialists like OFX, which I also use from time to time. But lately, I've mostly been using Wise. I think it's great. So, I mean, I think that's another theme about using Sharesight to manage your portfolio is, one of the things I really like about Sharesight is that it creates a bit of a wrapper to let you pick the best of breed tools to help you manage your portfolio. So, I want to use Wise for foreign exchange. I want to use Zero for accounting. I'll use Class for some of the compliance stuff. Um, I've got online brokers in the US. If I think so many investors get tied into one way of doing things. The extreme example of that is whether you're some kind of wrap platform where everything's managed by the wrap, the cash, the brokerage, the funds that you're able to buy. Look, for some investors who maybe aren't confident investing or don't want to spend the time, fine. But for a self-directed investor like me, I want to choose. I want the best tool for the job. And usually it's a cheaper tool too. So it saves me vast amounts of money compared to a more traditional approach, particularly if you've got, a larger portfolio in terms of the dollar value. You can really make some big savings in my view. Anyway, so I digressed a bit. So look, looking at this, I think I'm going to, and it's sort of a question of not sort of when I'm looking to draw down or when I'm looking to increase my cash buffer, I'll probably target some of the active stocks first. The international look, maybe it's a little heavy again because the S&P's done so well, so I'll probably trim that. I'm relatively happy with the mix, the split of active versus passive. If I don't think my active managers or ETFs are doing well, I'll definitely sell those down and move more into the passive category, but I sort of look at the two together. Bonds, sorry, Aussie passive, I could probably own a bit more, but the problem I find with Australian stocks, and not that I'm anti-Australian in any way, but it's just such a limited pool in terms of, it's great for big financials, big mining, and a few others. That's fine, but they get small pretty quickly, and there's not as much to invest in. So I just find the investable universe less interesting. I do want to have a core holding in Australian stocks. I live in Australia, so I'm happy to have that mostly through a passive ETF. I might boost that a little bit more. Bonds, that's the other one where I'm probably underweight still, and over time I'll look to boost that. So, active stocks, if I sell, I might boost the bond component, and similarly with the international. So over time, my asset allocation is probably going to get a little bit more conservative, but I'm not in a huge rush to do it. So that's diversity. Let's take a quick look at the exposure report. How are we doing for time, Prashant?
Yeah, so we are about half an hour in, so maybe
Okay.
have another 10 minutes or so,
Okay.
and then we can get into Q&A. And maybe some of the questions, while answering some of the questions, we can go through these specific reports as well.
Yeah, sure. I'm going to quick look at exposure. And then, exposure, for those of you who haven't used it, basically pulls out the underlying stocks that you have in an ETF. And obviously, as you can see in my case, I've got quite a lot of ETFs. So this has been quite interesting for me. It's not something I need to look at every day. Let's look at, I'm going to look at it by do not group because I want to see the underlying holdings. I don't look at this every day, but when it first came out, maybe a few times a year, I'll look at it just to see what my exposure looks like. And so what I'm going to do, I'm just going to rank it by the biggest to smallest. So this is my portfolio with the underlying positions in there. Now, my biggest single stock holding is actually IGL, the company I'm on the board of, which I mentioned. That's not necessarily true in my actual portfolio, but in this demo it is. But look, I'm a director. I like the company. I need to support the stock, so I'm happy to do that. The second biggest one, interesting enough, is Caterpillar, which is a company that I've owned for some time. It's been a terrific stock and one that I'm a big fan of. But you can see here that it's also within VV, which is that S&P 500. So there's a small allocation there. It doesn't really move the needle in terms of my holding in the stock, so that doesn't matter too much to me. It does underscore that I've probably got too much in Caterpillar, so I'm probably looking to sell that down a little bit. And partly it's just a function of it's done so well, but I don't want to be overly exposed to that stock. Berkshire Hathaway is another one where, yes, I've got 8,000 indirectly through the Vanguard ETF, a much bigger position individually. Again, look, interesting. I'm not too fussed about it because Berkshire is so diversified. I sort of almost treat that as a managed fund. But you get further down, Woodside, okay, 7,000 through the Aussie passive ETF. What else? I suppose the other way to look at this is stocks that you don't own, but you have an interest in. So, obviously, I have a sort of a tech background. I'm interested in tech stocks, but I don't actually own any of the big US tech names directly. I do that through the ETFs. And, I'm happy to do that because I don't have any particularly strong convictions or, particular insight into which ones are good or bad. So I'm happy to hold those passively. But it's interesting just to say, okay, well, how much do I own? Microsoft, even though I don't own directly, nearly $40,000. That's a decent holding. BHP, I don't own directly, but a decent holding. Apple, 36,000. There's also another chunk through Berkshire, which isn't reflected here because the exposure report just gives us ETFs, not necessarily underlying stocks like a Berkshire, Nvidia, Amazon, all the big names. So it sort of says, okay, well, I don't own them directly, but I can see I've got some decent exposure indirectly. I'm happy with that. So that's exposure. And then lastly, just going to have a quick look at a new report for us, which is out in beta on expert users. You may or may not have seen this, but I think it's a really interesting report, which will be available to everyone soon. And I'd certainly encourage you to have a look at it. So what the drawdown risk is it looks at the portfolio sort of on two dimensions, not just return, which we've always had, but also risk. And we measure risk by using a method called maximum drawdown, which is a fairly common sort of proxy for risk. There's obviously others, but it's a fairly simple one, which looks at the drawdown from high to low in a particular stock. So what's the maximum it's gone down since you've owned it? Which is a pretty good proxy for risk, I think. That's not perfect, but it's a pretty good one. So let's just run this for the portfolio. So what you can see here is on the this axis here, the return, annualized return. This is the maximum drawdown risk. Let's get rid of that message. So all things being equal, you'd expect your bonds and your cash to be down in this lower corner. And then as you get more risky, you go up this way and you'd expect good returns. So in some ways that sort of works, but not exclusively. By the way, this is since 2019 that I'm looking at. So you can see why is that company I mentioned. It's had very great returns, but also pretty risky. So that's, kind of what I'd expect to see. The size of the circle is the holding size, by the way. Okay, and then over here, okay, this company that I'm a director of, IVE Group. So you look at that and you say, uh-oh, that's been extremely volatile, but hasn't necessarily had the return to match it. Now, in this particular case, there's a very particular reason, which is over COVID and lockdown. That stock got completely hammered because it does a lot of printing for big grocery retailers like Kohl's and Woolworths, and one of those contracts was canceled. And in fact, the stock got completely hammered. It's actually recovered fine, and in fact, if you run the the drawdown risk over a shorter time frame. You can see, where's IVE group? IVE is, yeah, here we go. Much more where you'd expect it to be. So much further down the risk and actually pretty decent in terms of risk, in terms of return. So, one of the first things I'd say, and this is true of any of these reports, they help give you insight and understanding. You shouldn't necessarily blindly follow what they say. Oh, IVE group is rates poorly, I'm going to immediately go out and sell it. Or, WISE has been great. It really is, it's a tool to help you understand, not necessarily to take immediate action. But, it has certainly given me insight. One of the things you can do here, you can highlight this and sort of drill down into a smaller area, which I'm going to do. So I'm going to look at some of these in the middle of the pack, and these are some of my ETFs. So you can see Berkshire Hathaway, Vanguard, which one's that? That's the S&P. That's the Morningstar wide moat. So right here you can see a couple interesting things. Berkshire's outperformed. This is since 21 actually. That Vanguard ETF with a similar level of volatility. The moat ETF, similar level of return, but actually less volatility. So less, in theory, less risky. I mean, that's kind of an interesting insight. And the difference is not massive, I will say. But, that's kind of interesting to know. Down here, I've got this is the ETF outside the US. It's been both more volatile and less risky than the US. Overseas stocks, European exchanges, some of the emerging markets have really underperformed. Same with Japan, actually, here in this longer period. More recently, Japan's been pretty good. But, again, this is not to say, oh, well, I'm going to, just sell everything outside the US, do everything in the US. US has had a tremendously strong run. If anything, you may want to rebalance. But it just helps you understand what's going on. And again, here, this is the Aussie ETF. Lower returns, but much lower volatility, more than I would have thought, actually, interestingly enough. So that's, again, there's a role for the Aussie ETF, even if it's underperformed, because of that lower volatility, and obviously other things like franking credits and whatever, which make Aussie stocks so attractive. So, really, that's helped me understand, my portfolio and given me some insight without necessarily leading to immediate action, but helped me just to think more deeply about what I've got and, does it still make sense? So that's a very quick intro to drawdown risk, but when you get access to it, if you haven't seen it already, I definitely encourage you to play around with it and let us know what you think, and let us know if it's given you any insight into your portfolio. Okay, should we talk about tax, Prashant, or do you want to throw it to Q&A?
Yes, Andrew. There are a few questions on the tax side as well, so I think
Okay.
yeah.
Okay, so let's talk about tax. I'm going to focus. There's obviously several with tax. There's the taxable income, which shows you over a given financial year what your income has been. I think that's just running. As I said, because my accountant uses class, for the SMSF, I don't actually use these reports as much as I might so what are we looking at here? This is so let's say, I think this is last financial year. So, this breaks down your income, all your franking credits into non-trust, trust income, overseas, withholdings, etc. Now, this is somewhat duplicated by class, which sort of does similar things. So I don't necessarily rely on this report in my case for my doing the tax return or whatever, but it does essentially represent the same information. There are areas where class, they don't necessarily have full coverage of overseas brokers. So I'll have to, I think my broker actually, my accountant actually uses Sharesight, and my accountant has access to my Sharesight account, so they can go in and pull this information if they need
Yeah,
to.
if you can show people
yeah.
how to share portfolio, Andrew, I think that might be helpful. How
Yeah.
maybe at the end. Yeah.
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 But you can certainly share it, and I would certainly encourage that. I mean, I share full access with my accountant, so they can see what I'm doing. If they've got questions or anything doesn't make sense to them, to me, we can use it. And I actually will load up some documents as well, which will help them kind of get access to them if they need it. But I will say the one that the tax report that I use probably the most often in Sharesight for my SMSF is the unrealized capital gains tax. So this is the potential capital gains liability on shares that I haven't sold. So, okay, that was at year end, but let's move it to today. Or we can run it at the end of this month. So this is basically all the tax position of all my unrealized holdings. Fortunately, you can see there's more gains than losses, so that's a good thing. But I use it particularly because if I'm planning to sell something, when I make a sell decision, it's primarily based on some of the things I already talked about: asset allocation, how I feel about performance, rebalancing the portfolio, drawing down for income, whatever. That's the primary reason. But at the margin, if there's an opportunity to sell, if I sell something that's been in profit, and the S&P 500 ETF, there's a lot of profit sitting in that one because I've owned it for quite a long time. It's done very well. Are there some loss-making positions that I can sell to offset that? Probably the main one I think about here is Woodside. Where Woodside actually over the long term I've done fine, but I did buy some stock at a higher level above where it is now, and it's in a loss, and I'm thinking, okay, well, how do I feel about Woodside? Am I happy to sacrifice some of that, sell some to offset gains in the S&P 500? I might be quite happy to do that for a variety of reasons, and it just helps me offset the gain in the other asset. So that's something I would encourage everyone to kind of just look at it. You don't have to take action based on what it's spitting out, but it can help you optimize your tax position at the end of the year. And the capital gains, as I said, it is what it is. In my accountant's case, I think they tend to use the class report more than the Sharesight report to draw this, but it would essentially show the same information. So that's a very quick run through. Does that, are there any specific questions, Prashant?
Yeah, there are lots of questions, Andrew, so we can start
Okay.
with them if that's okay.
Yeah.
Yeah, thank you for that overview. And just for those of you
I'll
who
go back to the overview. Do you want to keep sharing or do you want to stop sharing?
maybe you can keep sharing. Maybe there
Okay.
are certain parts that require a
demo. Sure.
demo. Yeah. So the first question is from Ian. Unrealized capital gains tax report with large portfolio with numerous trades and DRPs need to be able to filter to check current status of gains, losses of individual stocks. I think that is just a comment, so we'll just take it as a comment.
Right. This, by the way, shows every, yeah, I would, if you're saying you'd like to be able to group it and filter it by stock or something, I kind of agree actually on that one.
Oh, yeah.
I mean, this would show every parcel effectively, what that would be sold and what the profit is on each parcel. So, and you can export it to a spreadsheet using this to sort of filter or sort it if you want. But yeah, I don't disagree with the comment.
Yeah. There's another one which if Jen says, as per the total return for SMSF demo versus benchmark, would you consider making things simple and instead invest all of those into VDHG only?
Yeah, well, look, that's a great question. And I think that's one that investors should be asking themselves all the time, right? Because Um, how much time do I spend on my SMSF? Probably a day a week. Maybe, it comes and goes. Um, Most of that, to be honest, is thinking and reading, like I'll spend 10 hours reading for every 1 hour that I'm actually doing something, buying or selling. Probably more, probably 25 hours to one. So I enjoy doing that. I find it useful. To me, I get some satisfaction out of it. But if I weren't able to outperform that benchmark, um, what's the point? Absolutely. And I think, more so within this. So in my case with the active stocks, which I showed where I'm sort of going in and saying, hey, I like this stock and I'm going to buy it and I'm going to buy a certain amount of it. If at the end of the day, that doesn't deliver returns greater than the benchmark, you really do have to ask yourself, what's the point? Now, okay, fine. It could be a hobby. You get some pleasure out of it. That's okay. And that's worth something. But, if you're meaningfully underperforming over long periods of time, I would certainly encourage, investors to think twice. Now, of course, these are not black and white things. Just because it's underperformed in the past doesn't mean the same will happen in the future or vice versa. Investing is not straightforward, but I see nothing wrong with well-structured passive portfolios. I don't think that everyone needs to be, taking big bets all the time. Just depends on your risk tolerance, your knowledge, your willingness to spend time at it,
Yeah. Yeah.
and your interest, really. My wife, and maybe I don't know how typical or atypical we are. I do most of this. She has an interest in how we're going and obviously the portfolio, and she's contributed to it over the years. But if I were to get hit by a bus, I think she'd probably take a simpler approach to managing the portfolio. But this is another thing actually with sharing. And in fact, recently my wife and I have spent some time talking about this issue. Is I really, even though I spend most of the time on the portfolio, I really want her to A, have access to it, and B, understand what I'm doing. So, I joke that we have an investment committee, which is myself and my wife. And if I'm going to do something meaningful in the portfolio, I'll call a meeting of the investment committee and tell her what I'm doing and sort of get her okay, whether she's interested or not. Because I think it's important that both parties or all parties understand what's going on. And particularly when it comes to risk tolerance, is everyone comfortable with what's going on in the
Yeah.
portfolio?
Yeah.
And
Yeah.
Sharesight facilitates that. She gets a weekly email with what's going on, even though she doesn't log in very often. Yeah.
Yeah. There's a few questions on investment property tracking, Andrew.
Yeah.
So just
Yep.
club all of them together. Yeah, probably a quick explanation would help.
So yeah, I don't have any investment property in the SMSF. I do have we do have some investment property outside the SMSF, which I do track in the SMSF. Sorry, I do track in Sharesight. So I treat it as an unlisted custom investment. I track the income. I track the returns, and by that I will try and revalue what I think the property is worth periodically. Um, um, and even though in our case the property we've owned for a long time, 20 years, and we're not planning to really sell it, but I try and keep myself honest. And this is about benchmarking. How has the portfolio performed? So I do go in. I'd probably go in three or four times a year and try and put in a value for the property, based on looking at, there's actually some pretty good sites that will help you do that these days, and you can always get an agent in or whatever. And, I'll try and put a value in it, and I'll try and keep myself honest because I want to know how it's going. I've got an allocation to an investment property. Has it been a good investment? How is it doing relative to other things? I want to know that. So, now, one thing I will say in terms of like tracking property expenses and that sort of stuff, I use Zero for that. That's something you can kind of do in Sharesight, but not easily. We're actually doing some work the team to enhance that sort of expense tracking capability because we've had requests for it. But I'd say at the moment, if you're doing a lot of property investing, I would use a tool like Zero to track it through a general ledger.
Yeah.
It's much more granular and I think more capable, and is worth doing. So that's my answer there.
Yeah, cool. Thank you. Thank you, Andrew. And there is another question on just unlisted investments in general.
Yep.
So I know you have quite a few private investments. So like,
Yep. So let's have a look at a Critical Arc, which is a real company. It is not, I don't think this is the exact number of shares and things I own, but this is a company, I've owned it for quite a long time, nearly 10 years. I made a couple of investments and I, where's my, if you go in here, custom investment prices. So here I track the value of this portfolio of the stock. Now, again, this is a bit like property, and typically with private companies, they don't necessarily get valued all that often. And there's kind of two issues. One is investment performance and tracking. I definitely try and track my investment performance in my unlisted stocks, and I mark to market, if you like, as often as I can. So obviously, if there's a new capital raise, if there's been a valuation, you get something from the directors to say, hey, the stock's worth whatever, I will put that in. But even if I don't get something, I will try and mark to market, even on an unrealized basis, how I think it's going. So for example, outside the SMSF, I've got some other SaaS businesses. Investment returns, investment valuations have been quite volatile. And I would say it's fair to say since 22, they've dropped quite a bit. I've gone in and I've dropped the value of those investments based on my own research, even though the board and the directors of that company have been reluctant to do something about it. I'm like, well, I want to know what it's worth. That matters to me. So I do that. Now, there's the bigger question, and this may be what the questioner is getting to, of the valuation for SMSF purposes, which is more complicated because you need to, from a compliance point of view and an audit point of view, be able to substantiate the value of the investment. So you can do that here using the custom groups and put it in. That doesn't necessarily provide a substantiation because you can put in whatever number you like. So then you have to go to other sources, which is whether it's a director's valuation, whether it's an independent valuation from a valuer, whatever it may be. So Sharesight doesn't necessarily help you do that, but it does help you record, and you can track in against the asset, the justification. You could put it in a valuation report. In my case, in the case of, say, Critical Arc, I've used some directors' valuations. I've used an independent kind of research company that tracks SaaS valuations, and I've extrapolated what they say back to what I think it means for Critical Arc. And in the case of the SMSF auditor, they accepted that as a reasonable valuation. So it does depend, and that's an area that's getting increasing scrutiny. And if and when some of these changes come through with unrealized gains on portfolios worth more than 300 or some more than 3 million, it's going to become even more critical. So we may look to develop some additional tools to kind of help you track those values. I don't think we'll be able to solve the what is it worth question, but maybe help you document it a little more easily. But that's certainly a big question for SMSFs. Personally, I think going forward, in the past, I've been quite keen on having some of these unlisted investments in the super fund because of the low tax rate, long time horizon. Like in theory, an SMSF is a good place to put these assets. I think going forward, if the new legislation comes in, it's much more problematic because you could be liable for big unrealized gains or losses, without the ability to pay for it or not having disposed of the investment. So it becomes much more problematic. Whether I would actually sell, let's say, Critical Arc and move it out of my super fund. I mean, now that I've reached preservation age, I could do it, but I'd still I'm not sure, I think that's a nuanced decision that you'd have to talk with your accountant or advisor to make a sensible decision. I think it's actually quite tricky going forward.
Yeah.
So the landscape has changed a bit, or will change, assuming these things come through, which looks like they will.
Thanks, Andrew. A couple of other housekeeping questions.
Yeah.
Patricia has asked, I missed the first half of your presentation. Will it be recorded? Yes, it's all recorded, and we will share the recording on our YouTube channel, and you will also receive an email for every one of you who has registered for the webinar. Another anonymous attendee has asked, can you also track crypto and Sharesight? The answer is yes. We do allow you to track. We have automated pricing information for the top 100 or 150 big cryptocurrencies. So that's already available within Sharesight. So you can definitely try it out using the share checker tool or even just add a holding and see
Yeah.
crypto it is. You will be able to track those.
Yeah, I don't own any crypto anywhere in my portfolio, so I'm not particularly a crypto guy. But yes, we do offer support for it. I think the drawdown risk report, we don't support crypto, I don't think yet in that report,
No,
Prashant.
not yet.
We
But yeah.
will. And I think that'll be interesting because risk return is clearly something for those more volatile asset classes where you really want to understand what's going on and how it impacts your overall portfolio. So I
Yeah.
think that's
And
quite useful.
yeah. Again, on drawdown risk, an
Yeah.
anonymous question, will drawdown risk be available to investor users? We haven't made the final call yet on that, but most probably yes is the answer. So yeah, please watch out on this, watch
Yeah.
this space. The other one is on another anonymous question. Will there be the ability to manually add other assets such as investment properties so we can track the entire portfolios? Hopefully, Andrew's answered that question through some.
The custom investments, if you haven't used it, is your friend there. Custom investments, in a way, it's not very helpful, but it's very flexible. You can literally track anything you want within there. In my case, I use it for unlisted private companies, property, things like that. We're actually doing some work to kind of, rather than just calling it custom investments, to break it down into more useful categories. So that's something, an enhancement we're actually working on that will maybe be a little bit more user friendly. But even right now, you can play around with it. You can literally track virtually anything within custom investments, and you can label it. You can use custom groups to have categories for property, for crypto, for unlisted, for whatever you want. Artwork, collectibles, you name it. You could track through custom investments.
Yeah, thanks, Andrew. And just on that custom investments note, we see all varieties of investments that our customers track. So right from art to, vehicles like, vintage vehicles, vintage cars, all sorts of things. So it is a very useful. It is a very
I have a portfolio actually that I use to track kind of non-investment, like my own house, which obviously is an investment, but it's not an investment property as such. I mean, I track my house in there just because I'm interested in its performance over time. But I track the insured value of all my home and contents as well, just to kind of keep a sense of it. I track motor vehicles. Those are clearly not investments, but I track them just so I can get an overall net worth position, and just for interest's sake. So yeah, there's all sorts of things you can do with it.
Yeah, we are running out of time, so just kind of sorry we couldn't get through to all questions, but please feel free to reach out on support@sharesight.com. We'll try to collect all these questions and answer them either through the content of the email or specifically. So watch out for those. So thank you once again to all participants. Thank you, Andrew.
Yeah, just if I can just make a closing,
Yeah,
some
sure.
closing words. I think the main thing about Sharesight, and the thing, obviously I'm biased because I'm the chairman and a shareholder of the business, but the thing that attracted me to this business, because I started using it as a user before I invested in the business, is the flexibility it gives you to manage the portfolio the way you want to manage it. And now, for some people, that's not that important. For someone like me, who's a lifelong self-directed investor, it's been hugely valuable. And I use it virtually every day. The way I use it is certainly not the way that other people need to use it. Don't take it. It's certainly not prescriptive. It's really about the flexibility, I'd say, more than anything, that gives it its value. So I'd encourage you to play around with it, use it. You're not going to break anything by putting things in. If you have, give yourself a dummy demo portfolio as well, and use that as a bit of a sandbox to try things out separate from your real portfolio. That can be useful too. So, use it as much as you can, and test its limits. We like to see that, and tell
Yeah,
us where we could do better. We also want to hear that too. So
absolutely.
thanks for your time, everybody.
Thank you.